Every time the world faces a financial crisis, we're told the same story. This is temporary. Emergency measures, just until stability returns. But here's the unsettling question no one asks out loud. Why do the emergency powers never disappear? Interest rates rise, surveillance expands, rules tighten, balance sheets explode, and when the crisis ends, the control remains. The tools introduced as short-term fixes quietly become permanent features of the system. This video is not about blaming one institution or one group. It's about tracing a pattern over centuries where crises don't weaken financial power, they concentrate it. And once you see the pattern, you can't unsee it. Setting the stage: money, fear, and authority. To understand how central banks turn crises into permanent control, we need to rewind to a simple truth. Money has always been about trust. Long before paper notes or digital balances, money represented a promise. Gold coins worked because people believed others would accept them tomorrow. But trust is fragile and fear is powerful. Whenever fear enters the system, people don't demand freedom. They demand stability. And whoever provides stability gains authority. Central banking did not emerge as a neutral innovation. It emerged as a response to chaos, wars, panics, collapses, and revolutions. Each crisis created an opportunity to centralize decision-making for the greater good. The twist? Once power is centralized, it rarely decentralizes itself. Origins: crisis creates centralization. The story begins in late 17th century England. The government was drowning in war debt. Tax revenues were unstable. Credit was unreliable. The state needed money fast. So in 1694, the Bank of England was created. Officially, it was a solution to a crisis: lend money to the government in exchange for stability. Unofficially, it changed the structure of power forever. For the first time, a centralized institution could: 1. Control the money supply, 2. Set interest rates, 3. Decide who received liquidity in emergencies. This model spread not because it was perfect, but because it worked in moments of panic. The same pattern repeated: 1. France after repeated fiscal collapses, 2. The United States after banking panics in the 1800s, 3. Europe after wars and hyperinflation. Crises didn't destroy central banks. They justified them. The rise from backstop to command center: originally, central banks were supposed to be lenders of last resort. Their role was narrow: 1. Step in during panic, 2. Prevent bank runs, 3. Restore confidence, 4. Step back. But history didn't unfold that way. Each crisis expanded their mandate. After the Great Depression, central banks gained broader control over credit. After World War II, they became architects of global monetary order. After the collapse of the gold standard, they gained unlimited flexibility. And with every expansion, one principle quietly disappeared: constraints. Once money was no longer tied to gold or fixed limits, central banks could create liquidity without immediate consequences, at least on paper. Crises became moments where 1. New tools were introduced, 2. Old rules were suspended, 3. Extraordinary authority was normalized. And crucially, the public was told, this is necessary. Breaking point when temporary became permanent. The modern era exposes the pattern most clearly. Take the 2008 financial crisis. Banks failed. Credit froze. The global system teetered. Central banks responded with 1. Zero interest rates, 2. Quantitative easing, 3. Massive asset purchases. These were sold as emergency measures. But ask yourself, why did zero interest rates last over a decade? Why did balance sheets never shrink back to pre-crisis levels? Why did financial markets become dependent on central bank signals? Because once markets adapt to intervention, removing it becomes destabilizing. The system breaks not when control increases, but when it's withdrawn. So instead of reversing emergency measures, central banks institutionalized them. Temporary became structural. Fallout control without visibility. The effects weren't immediate, but they were profound. Cheap money inflated asset prices. Debt became the engine of growth. Savings lost purchasing power. Inequality widened, not by accident, but by design incentives. Those closest to new money benefited first. Those dependent on wages absorbed inflation last. Yet none of this was framed as control. It was framed as 1. Stability, 2. Growth, 3. Recovery. Central banks didn't need force. They controlled incentives. And incentives shape behavior more effectively than laws. Failed fixes solutions that deepen dependence every time cracks appear. New fixes were proposed. More regulation, more coordination, more intervention. But each fix relied on the same authority that created the dependency in the first place. After COVID-era shocks, central banks went further than ever. 1. Directly funding governments. 2. Backstopping entire markets. 3. Signaling future policy years in advance. The line between monetary policy and economic planning blurred. And once crossed, it never fully uncrosses. Because reversing control would mean accepting instability, and instability is politically unacceptable. Modern parallels. The pattern repeats. Look around today. Global debt is higher than ever. Interest payments rival social spending. Markets react instantly to central bank language. Entire economies hinge on rate decisions by unelected committees. Each crisis reinforces the same logic. We can't afford to remove support, so support becomes control. Control becomes normal. Normal becomes invisible. The pattern is clear. 1 crisis gives emergency powers. 2 emergency powers gives dependency. 3. Dependency gives permanent authority, not through conspiracy, but through incentives. 3 takeaways. 1. Crises don't expand control accidentally. They create emotional conditions where people trade autonomy for stability. 2. Temporary financial measures rarely stay temporary. Once systems adapt, reversal becomes more dangerous than continuation. 3. Control today operates through incentives, not force. You don't need coercion when behavior is shaped by debt, credit, and liquidity. Final warning, the most effective form of control is the one people stop questioning. Central banks don't need to seize power. They inherit it 1 crisis at a time. The real danger isn't collapse. It's normalization. Call to action. If this changed how you see money, debt, or crises, subscribe for deeper breakdowns of financial history and hidden systems. Because the past doesn't repeat itself.